Hello, everyone. My name is Lauren Adams, and I'm a partner and certified financial planner here at the Center. It's my pleasure to welcome you today to our annual investment event, where you get to hear about the Center's latest thoughts on the markets and the economy and what it means for your portfolio and your financial plan. You may be brand new to us, or perhaps you've been a client for 30 years or more. You're all important stakeholders, and we wanted to share a few updates about the latest happenings at the Center before we dove in. The Center now serves 1,000 families and manages about $1.5 billion in assets on their behalf. We have 30 team members, and we spend a lot of time focusing on workplace culture because we think happy team members translates into a better experience for our clients. We now have 15 certified financial planners. You heard that right. A full half of our team now carries this gold standard in the financial planning profession. Since our founding in 1985 by our three founders, Dan Boyce, Marilyn Gunther, and Estelle Wade, we are now on our second and third generation of ownership, and we count 7 partners among our ownership group. We are sure proud of our history and our team, and we are so honored for the opportunity to work with you to reach your financial and your life goals. Now, with that quick Center update, let's turn to our main event. First, you'll hear from our feature investment presentation. And then you'll have the chance to hear from one of our senior financial planners who will talk about some important legislative updates that are affecting the financial planning world. Now I'd like to introduce you to our keynote speaker for today, partner, director of investments, and CFP professional herself, Angela Palacios. As director of investments, Angela chairs the firm's investment committee, which is made up of Center senior financial planners and portfolio managers. She leads our investment department, which oversees everything from account trading to investment research. Under her leadership, our team has been able to reduce the average internal expenses of portfolios by 70% over the last 10 years. She was recently named a notable woman in finance by Crain's Detroit. Welcome, Angela Palacios.
Thank you, Lauren. And I'd like to thank everyone for joining today. As Lauren mentioned, we're going to be taking a look at what happened in markets in 2022 and taking a look ahead at what we think might be to come for 2023. And I'll also put my contact information up on the screen so you have that if you need to reach out with questions later. So with that, let's dive in. I'd like to start with just a recap of what happened in 2022. As you can see by this chart, there was nowhere to hide last year. Stocks, bonds, international investments all ended the year negative for 2022. Both stocks and bonds being negative for a 12-month return is exceptionally rare and has only occurred in about 2.5% of 12-month rolling periods in the last 45 years, so pretty rare. Many well-known target date and diversified strategies allocated roughly 60% stocks, 40% bonds were down in the range of 17 to 18% last year. So let's start and narrow in on the bond market first. With the bond market, when it comes to bonds, the best thing I can say for 2022 is that it's over. The biggest story of the year has been how drastically the Federal Reserve increased interest rates last year. The reason they did this was a good one. It was to fight inflation, but they were a little late getting the game started, so they had to make up for lost time once they did start. When you look at yields here, there's an interesting fact for you. If you think back all the way to July of 2021, so about 18 months ago, 19 months ago, high yield bonds were yielding about 3.7% on average. Today, that's what money markets yield, and probably even a little bit more on money markets now. So why were bonds down so much so quickly this year? Well, it was the starting point of yields. So look at in this chart how low yields were at the beginning of the year and how quickly those yields went up and how far they went up throughout the year. They started the Federal Reserve with a 0.25% interest rate increase, and then they accelerated throughout the year with 4.75% increases in a row and a 0.5% thrown in at the year end. So in the past, when we've seen rates rise, it hasn't been nearly as quickly or nearly as steep of an increase. So when it occurs more slowly, the interest rate you're earning has a little bit of time to make up for some of the losses, because the way bonds and bond yields and prices react, if you think of like a teeter-totter, when bond yields go up, bond prices go down. And that's what happened last year. Whereas vice versa, we've gotten so used to years where bond yields have gone down and the prices have gone up. So we've enjoyed many years of tailwinds for our bond performance. And last year, the opposite happened. So there wasn't enough time for the interest rate we were earning on our bonds to make up for those losses we were experiencing. And that's why it was such a rough year. The good news is that the year is over and rates might go up a little bit more, but certainly not as much as they did last year. So we shouldn't expect a repeat. If you look at kind of a traditional chart we've shared with you before on the equity side of things, you can look at it for bonds as well. It's a great chart to show what an anomaly that last year was for bonds historically. It was really a 1 in 40 year event. If you look at the bars here extending above and below the line across the middle, a bar above the line indicates a positive return that year for bonds, and a bar below the line indicates a negative year. So if you look all the way back into the 70s, you can see that there's never been a negative year like 2022 for bonds. There's also never been a year where the Federal Reserve has raised rates so aggressively, so quickly. The dots you see on this chart below the bars actually show how far bonds were negative at any given point of the year, even though they may not have closed that low. So even looking intra-year at returns for bonds, we've never seen it during the year a return that negative. So last year truly was a historic year. Prior to this 2022, the worst individual year for bonds was 1994. And many of you on this call may remember that. What's interesting to pay particular attention to here is in 1995, the sharply positive returns that occurred there. So while we may not see sharply positive returns, we will start to enjoy the increased yield we're getting from our bonds at a very minimum going forward. So for years like last year, there really was no alternative coming into 2022 of where to get yield in a portfolio. Now we're looking at yields in our bond portfolio actually making up a very reasonable amount of our return expectations. Coming into last year, you might remember us talking about this in the past, but we were anticipating rates to go up. We didn't anticipate this much this quickly. I don't think anybody did. But we did know something was going to happen, so we really shortened up on duration in our bond portfolios. And while it really helped insulate the downside, it didn't completely, insulate 100%. So we did outperform on the downside because of that short duration exposure, but it was still a tough year, even with that in mind. Looking ahead, I think bonds still earn a spot in a diversified portfolio, especially now with interest rates so attractive. Thinking of like municipal bonds, municipalities are the healthiest they've ever been. And I think that's a decent indicator of where the municipal bond market could be heading. They have a lot of cash on hand, able to pay that interest rate in a much different landscape there than we saw 10 years ago. Even a niche area like emerging market debt is also attractive. Their pullback started even a little bit before ours did here in the US, because their central banks started to attack inflation by raising rates back even into 2021. So they were a little bit ahead of us in the interest rate increases that they were doing. Turning over to look at stocks, I'd like to just talk about again what a historic year last year was. It was that year that bonds and stocks were highly correlated in both performed negative to the downside. This is the most negative and most correlated that bonds have been and stocks have been in 45 years. And much of that volatility was driven by several factors that I've listed here. And I think it's good to kind of look back through the year because it's hard to remember sometimes all the way back to the first quarter of the year last year. But we saw the Russia-Ukraine conflict begin, and that created a significant amount of volatility in markets. We had interest rate increases starting with that first increase in March. Then in the second quarter of the year, inflation really had set in at that point in time, and we were hoping to see more retracement in that or reduction in inflation, and it started to happen, but was extremely slow. We also saw mortgage rates starting to increase with the interest rate increases the Federal Reserve was doing. In the third quarter, we saw continued rate hikes. GDP was negative 2 quarters in a row at that point in time. So there was rumblings of recession. And then in the fourth quarter of the year, we had China relaxing its zero COVID policy. So the supply chain disruptions really started to alleviate at that point in time. They had throughout the year as well, but that was kind of the last piece that needed to be in place for that to happen. And looking over the year performance-wise, I mean, one of the bright spots in the market was the energy sector, which was one of the only positive sectors for the S&P 500 that year. But that was after many, many years of that sector struggling. So it was a little different market last year for sure than we had gotten used to in the past few years. Turning over and looking at international investing. This is a chart just going over the US dollar measured against a basket of currencies of its trading partners. And you can see that over the last 12, 13 years, the trend of the dollar has been upwards, meaning it's strengthening against those basket of currencies. And that's created a unique headwind for international investments. And we saw kind of a sharp reversal of that in the fourth quarter of last year. And that is really, it's significant for investments because it helps us kind of gauge where we want to be thinking about for international investments in your portfolio. If you look at this chart, the gray area of the chart is when US stocks outperform international stocks. And those purple areas are time periods when international investments outperform US stocks. So we've had a number of years. You can see that US has been very dominant. And it's been, difficult to kind of stick with that style of investing through that time period. I think this recent change in the strength of the dollar, it could continue. And if that were to happen, we might start to enter a time period where that purple or the international investments have a little bit more tailwind behind them. We don't know for certain. It's really hard to kind of predict the path of interest rates or the US dollar or many different types of aspects, but we are looking at still holding on to a strong allocation to international investments as we always have in the portfolio. So with that, let's look ahead to 2023. We already kind of jumped into a little bit of discussion there. And while we're on the topic of international investments, let's just close that out. Like I mentioned, our dollar strengthening over those many years could start to wane, and that would be positive for international investments. International investments also have some other positive aspects. If you look at valuations or PE ratios, which many use to determine how stocks are valued, they're very low for international investments compared to the US. And higher dividend yields are also kind of a hallmark of international investments. They tend to distribute more of their earnings in dividends than companies here in the US. But even, after that last decade, that was pretty tough for international investments. We hear quite commonly from people, why bother? That seems to be kind of the prevailing wisdom. Why bother owning international? And when sentiment is that low for a space, it doesn't take much performance to kind of surprise those naysayers and create a really strong return potential environment for a space. So like I said earlier, it's really hard to predict the path of the dollar, and it's something that many experts get wrong frequently, but we think the odds might be in favor for that helping international investments this year. Turning over to like US stocks, the purpose of this slide is really to evaluate whether or not we think equity markets are overvalued or undervalued, and if so, by how much. And we look at that in relation to standard deviations over the last 25 years. So the 3 dotted lines here kind of represent that. The middle dotted line is the average PE ratio of the S&P 500 over the last 25 years. The dotted line above and below represent one standard deviation from that average. So you can see we ended the year last year right about on average. So while this doesn't make me jump up and down that things are really cheap, it also looks like we're in a much better situation than we came into 2022. In 2021, the very end, markets were very richly valued. So we started the year off this year with one of the strongest Januaries we've had in the last 25 years. And if you look at how January goes, sometimes the rest of the year goes that way. It's usually a very good omen when you have a positive January that you're going to have a positive calendar year for the rest of the year. So that's where we kind of think things are headed as far as US goes. If you look at where we ended the year in the PE ratio, this is kind of a busy chart, so I'll explain it. But if you look at all past instances where we ended the year or had that level of PE ratio, that's the red diamond. So where we ended last year, that's the where we are at the end of 2022 coming into this year. And the gray dot or the gray diamonds that you see on the chart are different forward returns that happened from that PE ratio level. So what happened with the S&P 1 year later when PEs started at that point? And that's the left-hand side. Or what happened 5 years later when PE ratios started at that level. So you can see that on 1 and 5 years, we usually see positive returns. There have been some time periods that were negative, but usually you see positive returns over the coming 1 and 5 years from that point. And while past performance is not a guarantee of those future returns, it at least does give us a little bit of historical perspective of what we can expect. I do think earnings estimates maybe haven't come down enough yet, so we could still see some volatility in markets for a while. And we continue to hold a little extra cash right now just because we think there might still be some added volatility on the horizon and that we might have some opportunity to deploy that. But that kind of gives us a little perspective of what we might be able to expect this year. So what about bonds? If you look at this chart, I think it looks at like the forward expectations of what the market is thinking the Federal Reserve is going to do. And I think it is somewhat correct in that the Federal Reserve is going to cap out their rate increases this year. It'll likely be in the first half of the year. They might raise rates a couple more times. They've done it once already this year, 0.25%. And that markets are actually, I think what's unique here is markets are actually expecting rates to start to come down towards the end of this year. So they think the Federal Reserve is going to start cutting rates toward the end of the year. I think inflation would have to really retrace its steps, and it's been pretty stubbornly slow in retracing its steps. So that might not happen as quickly as people would like to see, or the Federal Reserve would like to see. If a recession doesn't happen, they might not need to cut interest rates. So I think there's still a lot of unknown out there. And I think it's unlikely that the Federal Reserve is going to cut rates this year. My guess is that we're going to see those next couple of increases, and they're probably going to hold steady for the rest of the year. We still are holding that kind of shorter duration allocation in our bond portfolios because we think the market might have to reset its expectations a little bit this year. But that's not a long-term allocation, but it's something we will likely opportunistically change at some point this year. I also like to think about this chart. It's kind of funny when I explain what's going on here. It just goes to show like how difficult it is to predict the path of interest rates. It's a pretty hard game. And this chart shows an analysis of how good the experts are at doing that. If you look at the blue line on this chart, that shows what actually has happened with interest rates over the last 15 years, whereas the red shows what experts were predicting would happen. So you can see there's a little bit of a difference pretty much all the time. Experts were making one kind of forecast and something completely different was happening. So it just shows how difficult it is to kind of predict that path forward. So anytime something seems like a sure thing from the media point of view, I'd suggest you remember this chart and take that with a healthy dose of skepticism. Like I said, we continue to hold some shorter duration positions because yields are attractive. They're paying us very well to do that right now. And there still could be a little bit of risk that the experts are wrong. So some of those rate cuts at year end may not happen. And if that were to happen, shorter duration would help us in that case. We often get the question, and I'd like to take a minute here to address that, of should we own individual bonds or bond funds? And I think that's a really great question. The answer is, both can work in a portfolio. I tend to lean toward bond funds, and we have here at the center for many years. The reason is simple. Diversification is simplest in a bond fund. The funds can access or venture into areas that we may not necessarily be comfortable buying on an individual basis. And when I say that, it could be the lower quality or the lower kind of tranches of those investment grade debt. While we may be comfortable looking at AAA or AA rated bonds, kind of the highest quality, not so comfortable looking at bonds that are closer to being those areas where they could be downgraded into junk territory, because that can be pretty devastating on the individual bond returns. So bond funds can offer access to those areas where we're not necessarily comfortable venturing on an individual basis. They also have access to different bonds than we do. As an institutional purchaser, people go to them, or other institutions might go to other institutions first to try to sell a large block of bonds rather than selling 20 or 30 or 100 bonds to an individual investor. It's easier to sell a block of 1 million bonds to all one purchaser. So they simply get access to things that we don't necessarily get access to. They have better pricing power as well, so they can buy those bonds at cheaper prices. So it doesn't take a lot for them to kind of overcome the fees that are built into, say, a mutual fund structure or an ETF structure when they deploy their kind of active management skills. So for some investors, a blending of both individual bonds and bond funds can make a lot of sense. For other investors, it might make sense to focus more on just using the bond funds. So results can be very similar when you look at returns over the long term. And our bond funds are still carrying a very healthy yield right now. So it makes them attractive, even net of fees that might be charged by a fund manager. So I'd like to switch gears and go into our economic update. And I want to talk about, the question that's kind of on everyone's mind. And is there going to be a recession in 2023? I think, the technical definition of a recession is 2 negative quarters of GDP. And this occurred in Q1 and Q2 of last year. However, the National Bureau of Economic Research hasn't actually called a recession yet. And the main reason for that is because there's been a continued strength in the consumer, very strong job and employment market. You might be hearing, this year, like I said, many forecasting a recession to happen, and that is possible. The question is did markets already put in their recession lows because they are generally forward looking for recessions? And you can see in this chart that the drawdowns we saw in 2022 for the S&P 500 at one point hit a negative 25%. And that's pretty close to the average recessionary bear market return for the S&P. So a mild to moderate recession, that's about what you can expect to see markets down. And usually they're down ahead of that recession about that much. So we've recovered a lot since then. And if there is a recession, we could see a retest of those prior lows that we saw that occurred end of September last year. We could see a retesting of that. It's not necessarily our base case assumption, but if we did see a moderate recession occur, that could happen with markets this year. But I don't think it would be anything more than we experienced last year unless we were to see, a much more extreme recession hit. Like I said, I don't think that's very likely at this point in time. Turning over to the debt ceiling. This has been a really hot topic lately. I hate talking about this topic about as much as you hate hearing about it. It's this dance, a political dance we keep hearing about kind of over and over. Politicians are pushing the debt limit debate to the point that the markets start to react. The markets resist reacting because it's like the boy who cried wolf. It's happened so many times. We think it's going to be just like last time until we get to the very 11th hour and nobody's budging, and then markets might react a little bit. But the debt ceiling really, once the debt ceiling gets increased or suspended, historically speaking, even if we had a little market reaction, usually things go right back to where they started. So it kind of essentially eliminates any market volatility that you see in that 11th hour of the debt ceiling debate. So what's happening right now? I think a quick little recap is probably important. On January 19th, that's when the U.S. officially hit the debt limit. And at that point, Treasury Secretary Yellen sent a letter to the Senate suspending debt issuance, and it will likely be suspended until early summer. So there's an X date that you might have heard about. That's the point when the U.S. can't pay its bills and we have to start prioritizing our payments. So she outlined kind of some spending payment suspensions that can occur. It's in different areas that aren't necessarily that impactful. I mean, important long-term areas to fund, but things that can be suspended for now and caught up later. They might sound alarming, but they always do kind of catch these things back up. Republicans, naturally want to use this as a leverage to kind of negotiate some of their agenda items. So that's really what we're probably going to hear about over the coming, 4 or 5 months until that X date occurs. Hopefully they don't push us to the precipice, but this is a conversation that we're used to having. It happens very frequently. So the question is, will it be different this time? And I like to look at this chart because it shows how many times we've stood at this precipice. Since 1980, the government has raised the debt ceiling 78 times. So 78 times this has been a political game or a political discussion. 60% of the time, the debt ceiling was just suspended until both parties could come to an agreement. And I think that's one of the most likely outcomes. Either we're going to see the debt ceiling get increased or be suspended for a period of time until both sides can come to an agreement. The government does have some other options you may have heard of. They're a little more extreme, like minting $1 trillion coin. But I think those other options are very unlikely to happen. If no one crosses the aisle to help kind of make something happen, we could see some market volatility in the summer. If House Democrats are kind of able to pick off some Republicans to pass a debt limit increase, then we could all move on. Could this be different this time and maybe it look more like 2011? I mean, that's a possibility. That's what some people are afraid of. But making sure you have cash set aside for any withdrawals you may need this year, having a properly diversified portfolio, those are really the best ways to counteract that kind of short-term volatility that could be caused by a political standoff. It really isn't in the country's best interest to push this to the absolute brink, because that's what caused the Treasury debt downgrade back in 2011. So if this gets pushed past that X date this summer, there needs to be potentially more spending cuts. I think there could be another discussion of downgrade, but I don't think the politicians will let it get to that point, or they'll suspend the debt ceiling at that point in time to kind of buy some more time. If we did get another debt downgrade, that could mean higher interest rates that the government would have to pay. Nobody wants that on their watch. They're going up as it is already, and receiving a downgrade means you'd have to pay even more interest. And that could have some really bad long-term impact to the debt that the country has. And higher interest payments, they can become a much higher portion of GDP, and that's kind of something I think everyone wants to avoid. So right now the markets are actually bracing for this. If you look at the credit default swap market, they're pricing in that this could get pushed to the precipice and we could receive a downgrade. In 2011, when that happened, markets dropped here in the US about 15%, and internationally they dropped about 30%. However, once the debt ceiling was increased and things were able to go back to normal, markets recovered very quickly within a couple of months, and we're right back to where they started. And you might think that treasuries would perform poorly during that time period, but they actually rallied through that downgrade because they're still kind of the best in a bad neighborhood. So they still receive that kind of flight to quality trade, which is kind of counterintuitive if you think of it, but that's what actually happened back then. Turning over to geopolitical risks, I know I'm not going to talk about balloons, but we'll kind of continue to keep our ears open for what's going on with UFOs and balloons. But there's always risk that something geopolitically could push the economy over into a recession. And as an investment committee, we're trying to look for these factors that could signal a recession on the horizon. The state of geopolitical affairs is often an item of discussion. We've recently had a few that we've been paying attention to. The pandemic really exposed some supply chain vulnerabilities and heightened our reliance on technology here. Strategic competition between the US and China is a driving global kind of fragmentation as both countries are focused on reducing reliance on each other. The US has instituted semiconductor export restrictions on China and is looking to potentially do some other export controls. If this accelerates in scale, we could see some negative performance from emerging markets debt and equity, although we're pretty optimistic on that space right now, so that's not our base case. We're emphasizing active management right now to navigate that environment. Of course, the Russia-Ukraine war continues on, and that can always have potential to impact markets, especially energy markets. Unfortunately, the worst market moving events are usually the ones that we don't see coming. terrorist attacks or cybersecurity attacks kind of fall in that category. The Russia war carrying on could certainly lead to an increased threat of cybersecurity attacks. So it's really important to stay vigilant, as not only corporations or government organizations to stay vigilant, but us ourselves. Think about those text messages or those emails before you click on links. I mean, these things are going to do nothing but accelerate and get worse. Unemployment rate. So let's flip over and talk about the employment situation. Still remains very, very low, below 4% on the unemployment rate. And this is significant because the Federal Reserve pays attention to two things. They pay attention to the unemployment rate and they pay attention to inflation. So unemployment staying so low is a reason why, we may not ever enter recession this year. It also gives the Federal Reserve kind of the runway they need to increase interest rates to battle inflation. So that's an important aspect to look at when waging that kind of war against inflation here in the US. So let's talk a little bit about inflation and kind of what has been going on throughout last year there and what might be happening now. So inflation issues obviously persisted throughout 2022. They peaked in the summer of 2022 and started trailing off the rest of the year. You can see that peak was at 9.1%. And then it started retracing and reacting to those interest rate increases that the Federal Reserve was doing. It's clear now that the Federal Reserve's kind of main goal in their interest rate increases was to avoid a replay of the 1970s and kind of do whatever it takes to get back to those healthy inflation levels, even if that means raising rates so much we push the economy into a mild recession. Early on, we saw kind of the surge in prices come from more of those transitory components of inflation, more components that were related to the supply-demand imbalances, new and used car prices, those types of things, energy, food inflation. However, we've had sticky inflation since then, and that's really strengthened things like shelter and services, and that inflation could continue to hold on a little bit longer than people anticipate or that the Fed would like to see, which is why the Federal Reserve could stay strong in their path of increasing interest rates and not reducing them this year. That would cause them, inflation being stickier could cause them to remain hawkish in that manner. So we've started to see some surprises to the downside for inflation. So at least we're headed in the right direction there. So I'd just like to wrap up with some final comments here. Our investment committee, remains focused on that proactive decision-making, rebalancing, trying to make changes, whether it be, during calmer or more volatile markets. We remain disciplined in our commitment to diversification. This has changed. This has been unchanged over our 35-year history of our firm, where we've helped hundreds, maybe even well over 1,000 clients accumulate and plan for a variety of goals and life transitions like retirement, divorce, sending children or grandchildren to college, and other significant, lifetime financial situations. We've done this through all kinds of markets. We'll continue to be there for you. And I'd like to hand things back over to Lauren to talk about transition into that kind of financial planning work that you do with us and some of the headlines there.
Well, thank you, Angie. And as Center clients, you'll have the opportunity to hear more from Angie throughout the year through things like our newsletters, such as the investment commentary, or timely videos where you can get our latest takes on the financial and investment markets. But even though today's focus is on the investment landscape, hopefully by now you've learned that at the Center, we don't believe that investments can be viewed in isolation. It's the combination of investment management plus financial planning that we find delivers those great results. And recently, there have been some important updates on the financial planning world. Now I'd like to introduce you to one of our senior financial planners, Kali Hassinger. She's going to share these updates and how we expect that they may or may not affect our clients. A true example of the Center's value of education and personal growth, Kali has a slew of letters behind her name. from CFP professional to CDFA or certified divorce financial analyst, to recently adding chartered SRI counselor related to socially responsible investing expertise. Welcome, Kali Hassinger.
Thank you so much, Lauren. That was such a nice introduction. And thank you, Angie, for that awesome presentation. As Lauren and Angie both mentioned, we're going to switch gears a little bit here from investments and focusing on these newly enacted legislation that's affecting retirement and retirement savings. So in late December of last year, President Biden signed the omnibus spending bill, which I kind of trip over every time I try to say it, omnibus spending bill. And sandwiched within that huge 4,000-page document that was pushed through was a 350-page bill that's referred to as Secure Act 2.0, which we see here. And it is considered an addition to the Secure Act that was passed in late 2019. And it had a very significant impact on how we work with clients and generational planning. The Secure of Secure Act stands for setting every community up for retirement. And the purpose or intention of these bills is to expand access to retirement savings for the general population. The Secure Act 2.0 focuses very heavily on employer retirement plans and employer-sponsored plans. So your 401ks and your 403bs. Some examples of this are allowing part-time employees to contribute to employer plans more quickly. And in future instances, there may be a requirement to automatically enroll employees in retirement plans. But this provision or this bill included almost 100 provisions. So we will not be able to cover all of those today. We're just going to have some highlights and share a brief overview of some of the changes that will affect our clients, affect how we work with clients, and some things we'll be keeping track of for you. So one thing I'll mention about Secure Act 2.0 is that as opposed to the original Secure Act, it was not this is immediately happening and this is the new rule you need to follow in December. This is what you need to do in January. So as you can see on this timeline, please don't worry, I don't expect anyone to read the words on this slide, but you can see the timeline. The majority of the provisions start in 2024 and beyond. So gives us a little bit of a chance to learn and understand these changes and these rules. I just said that things don't go into effect until later, but actually there was one piece that's pretty significant and was enacted immediately in 2023. And that is that the RMD age was pushed back. The previous Secure Act pushed the RMD age back from 70.5 to 72. Secure Act 2.0 further pushed that age back to 73 and eventually to age 75 for those who were born in 1960 or after. Another highlight related to RMDs, the penalty for missing a required minimum distribution was previously a 50% tax penalty. This has been reduced to 20%. And it also gives you the option to even further reduce it to 10% if you report the missed RMD in a timely manner. So I think both of these changes in general are welcome and positive for the general public. So RMD focus, good changes. Now we're going to look at a Roth focus within Secure Act 2.0, which I know as a planner, personally, when we hear Roth, we're usually excited about it. Some of these are, a requirement, so it may depend on whether or not you want to contribute to a Roth. But, a quick refresher on a Roth, you don't get the tax deduction. The accounts grow tax deferred, tax free, and as long as you follow the rules, the withdrawals in the future are tax free as well. And one item that many people are talking about that I think is pretty cool is the ability to roll a portion of a 529 education savings balance up to $35,000 into a Roth IRA. This has created a lot of issues because, what are the actual, or not issues, a lot of questions, what are the actual rules? Who will this benefit? Who's going to receive those 529 funds in the Roth IRA? Unfortunately, there's not a ton of clarity on that yet. I think we'll learn more as the year goes on. But regardless of how it shakes out, I think it's a cool option. And now, that question, what if I overfund the 529? What if my child doesn't go to college? Well, there is a possible answer that those unused funds could be put and repurposed into a Roth IRA for retirement savings. Another item, ultimately adding to Roth, and this is the one where I was like, it could be good, but depending on where your income is, being forced into a Roth might not be the preference. But essentially, those who earn more than $145,000 in a year and are over the age of 50, so they're in that catch-up contribution phase, will be required to allocate their catch-up portion as a Roth employer contribution. So, think if you're making 401k contributions, you're over 50, that first $22,500 can still remain tax deferred. But this is suggesting that additional $7,500 that is a catch-up contribution will need to be allocated as a Roth, and you would pay income tax on that. So, that is, again, a requirement. The next piece appears to be completely optional, and the employee, essentially, you can see here, can elect to pay tax on the employer matching portion of a 401k contribution, but then that employer match can be allocated into a Roth portion of the 401k. So the employer match, which has historically been tax deferred in nature, you now may be able to elect in certain plans to have that function essentially as a Roth contribution into your 401k or 403b. So this is, a pretty significant change. In theory, if someone just starting out, if they choose this election, could have a 100% Roth IRA or Roth 401k, which is not something we see very often. Another significant change with Roth, the ability to contribute to a Roth, is with a SEP or simple IRA. And this actually went into effect this year. Historically, SEPs and simples have been 100% tax deferred. Now they're opening up that Roth option with these accounts as well. So if you're currently contributing to a SEP or a simple IRA and you think a Roth might be a good option for you, you can actually look into that now. And from a legislative or tax revenue perspective, I think the changes with RMDs and the changes with Roths kind of make sense because they're delaying the RMDs. So, giving up on that tax revenue, but then expanding, and again, in some areas requiring Roth contributions, which will create that tax revenue now because there's no tax deferral there. So we've covered the RMD and the Roth savings, but some other changes are seemingly driven by a topic that we discussed already today and has been discussed throughout the last year, which is inflation. And, ideally, as inflation is rising, the ability to save would be expanded as well. And this is addressed specifically in the Secure Act 2.0. But again, for those who are 50 and older in that catch-up contribution stage, in both IRAs and employer plans. Historically, the catch-up portion has remained pretty steady. So with IRAs, for example, the catch-up amount allowed is $1,000. The base contribution amount, $6,500 this year, that's historically gotten some bumps along the way, but the $1,000 has remained steady. So they announced that now that $1,000 catch-up portion is going to increase incrementally each year. And another catch-up change, and I think this is another interesting update, is that employer retirement plans will now allow for an extra catch-up period. So I've mentioned, 50 and older, you get that catch-up contribution. But now those who are between the ages of 60 and 63 specifically will be able to contribute an additional $10,000 to their employer retirement plans. So right now the total, if you're in catch-up mode, again, over 50, you can put a total of $30,000 into your 401k, for example. This is saying if you're between 60 and 63, you could theoretically get $40,000 total into your 401k and just employee contributions in any given year. And this kind of, inflation boost was noticed in other areas with the tax brackets when those were released, allowing people's, income to catch up with inflation without pushing them into another bracket. So it seems like, Angie talked to us about inflation, and that's something that they're acknowledging in the Secure Act with this change. So we've come to pretty much the last portion of the Secure Act update. I know I'm blowing through, and my other slides had a theme. This one really doesn't, but I just thought they were two cool pieces that I wanted to mention. So, the Secure Act, again, the intention is to allow greater access to retirement savings, to expand that for the general public. But one of the largest barricades to being able to contribute to retirement plans for those entering the workforce is those student loan repayments, the student loan debt that, is widely talked about now, or I should say starting in 2024, student loan payments will be considered elective deferrals, or a fancy way of saying, if you're making payments to a student loan each month, your employer can consider that a contribution qualifying you for the employer match. So even if someone is not putting any of their own money into the retirement plan, if they're paying on their student loans, their employer can put the matching contribution into the plan for them. So I think this is going to be a pretty big change for the younger generation, because the longer your account is open, the longer you're making contributions, the more time it has to compound and grow. So I wanted to mention that. And lastly here, a surviving spouse change with retirement plans. Another option is now available for a surviving spouse when inheriting a retirement account from their spouse who died. Right now, I would say the most common option is to consolidate accounts, to have, the surviving spouse roll the other spouse's account into their own, so they only have one to maintain, one to keep track of, one RMD. This option is saying that the surviving spouse can essentially leave the account as is, and future RMDs will be based solely on the deceased spouse's age and life expectancy table. So in a situation where the younger spouse dies first, I think that we might see this option being used more commonly than just that combination that we've seen in the past. So that is your Secure Act 2.0 crash course. And I will hand it back to Lauren. Thank you.
Thank you, Kali. That's a great overview, since I know Secure Act 2.0 has been on a lot of our clients' minds, and they're wondering how this may or may not affect them. So we look forward to talking to everyone at your meetings and check-ins this year, how your individual situation will apply to the updates that both Angie and Kali talked about today. So now, to close, as our managing partner, Tim Wyman, said in his recent year in review letter, the future is unknowable, but you can count on us to strive each day to provide clarity and confidence that you are making the best possible financial decisions, staying abreast of the economic and investment landscape that may impact your planning. We hope you spending time with us here today helps you do just that. We thank you for your continued trust and confidence in all of us at the center, and we'll see you soon.